Hey everyone, welcome back to Corporate Decoder. Today we're diving into the emerging markets local income portfolio to see how they're doing in the sometimes wild world of international finance. I've taken a peek and let's just say there are some interesting currency moves afoot. Buckle up because we're going to decode their latest shareholder report. Essentially, this report tells us what the fund owns, how much it costs them to run things, and how well they performed. It's like peeking under the hood of their investment strategy. If you're interested in understanding where your money is invested, make sure you're subscribed and ring the notification bell so that you don't miss our video. Also, come join the discussion with other Corporate Decoder fans on our Discord channel, which you can find in the description below. First up, this is a look at the emerging markets local income portfolio for the period of November of last year to April of this year. You can find extra details on the Eaton Vance website. Also, if you want to call somebody about this report, you can use that 1-800 number. So what did it cost to run this fund? For every $10,000 invested, the fund took out $44 for expenses. That's basically 0.86%. Now, the good news is that is less than 1% of $10,000. The bad news is that those less than 1% of $10,000. The bad news is that those dollars that get taken out of your earnings, that percentage of expenses, 0.86%, is annualized. This term just means that it represents a full year's worth of costs. Here is a statistic that I always like looking at, the portfolio turnover rate. Their turnover rate is 33%. Basically, this means they sell a significant portion of their investments and are quick on buying new investments. This may not be a bad thing, but it might indicate a more active or aggressive approach to managing all of those investments. So where is their money? The fund is betting big on sovereign or national government bonds, with almost 67% of their investments there. Sovereign government bonds are bonds that governments issue to raise money. Short-term investments are next in line with about 27%. Foreign corporate bonds are only about 5%. That means that they mostly want to play it safe with governance rather than individual companies. Now, this is interesting. They're playing the currency game hard. India is in the lead at over 13% of this fund's net long exposure, and after that is Mexico at 11.11%. That is the currency that those two countries use compared to the US dollar, and the fund managers are betting high. If you're scratching your head at terms like net long exposure, don't worry. Simply, this indicates the fund is betting that those currencies will go up in value compared to the US dollar. If those currencies get stronger, the fund makes money. If they weaken, the fund could lose money. Also, it's important to note here that the total long exposure is over 120%. What does that mean? It means the fund is employing some form of leverage to increase returns and potential losses. They also have a negative 4.3% in the euro. This fund is betting that the Europe is going to do worse than everyone else. Not many notes here, so we don't have to look too much to find what they do with our money. Here are some words from the company on how it works. Let's scroll down and see that actual portfolio of investments. So what specific bonds are they buying? For Brazil, they own something called Simpar Finance, 10.75% due in 28, valued almost $7.6 million. All in all, the foreign corporate bonds make about a little more than 4.5% of the portfolio. Now let's take a look at loan participation notes. We see here this note belongs to a financial service in Uzbekistan. The total value for loan participation notes are just under $13 million. The big slice of the pie is sovereign government bonds, which is where governments are taking loans from the group. One small example, Albania takes up about 2.4% with many loans all less than 1 million. Remember that thing about India and Mexico being the bet. Here we find that countries such as that one take up a high percentage in these sovereign bonds. For example, Indonesia has a very large percentage as well, with about 8.0% IMSI's sovereign bonds. For example, Indonesia has a very large percentage as well, with about 8.0%. Poland has a government bond that has almost $27 million due in 2036. Seychelles, a small country, only has 0.0% in this fund. Uruguay is very small as well, taking up only 0.1%. Here is an affiliated invested fund, which is when an organization invests into itself or someone like them. This is worth about 10% of the holdings. The fund buys and sells over-the-counter currency options. Basically, the fund bets on the going value of another nation's money. They also engage in centered forward currency exchange contracts. Remember that thing about betting on currencies like the Indonesian rupiah or Brazilian real? Those are examples of what you're seeing here. The fund is betting for or against an exchange rate. They also use cross-currency swaps, which involves trading interest payments with another party based on two different currencies like 3-month PLN or 3-month UR. The net increase in net assets came out to just over $57 million. 20. Well, there you have it, folks. We've just decoded the semi-annual shareholder report for the emerging markets local income portfolio. Now, from my perspective, a couple of things stand out. It is good that the returns are positive. It also has some problems due to its heavy reliance on government bonds in emerging markets. Those nations are more volatile than others and can bring unpredictable turns. It is also important to note the heavy speculation of different nations' currencies. There is a high reward but also high risk for those kinds of swaps. Their fees are relatively low, in my opinion, but are still a part of the process that you need to keep an understanding of. Ultimately, this portfolio strikes me as fairly aggressive. The focus on emerging markets definitely provides higher potential returns, but also exposes them to more volatility and unpredictable risks in those markets. The use of currency-related instruments also amplifies both gains and losses. Let me know what you think. Did any of these details surprise you? Are you more or less confident in this type of investment strategy? Leave your thoughts in the comments below and please give us a like to let us know you like this style of video. We deeply appreciate you subscribing for more of these deep dives. Lastly, if you are interested in talking about finance and investing, make sure to join our Discord linked in the bottom. Thank you.